All right, traders, it is the 1st of June 2017. My name is Jameson. Welcome to Behringer Trading. We are looking at a daily vertical bar chart of KGC, Kinross Gold Corp. I like this chart. We're showing some good organization. It looks like we're seeing some accumulation. We can appreciate that a lot of red bars here. There's a lot of selling, and the selling starts to contract, and we transition to that of buying. So we're seeing that there is a rotation between weak hands to those of strong hands. At the same time as we're making that transition from weak hands to strong hands, we can appreciate that demand is beginning to exceed supply. We have higher lows, and we actually have a new high. So now actually we've broken through the 200-day simple moving average. We broke through this current level of resistance, and we're in the process of backtesting this prior level of resistance and confirming it as support. It's pretty significant. And actually we're forming a nice organized bull flag that's present. So these only have like an 8% failure rate. This is a very high probability trade here from a classical pattern standpoint. There's a possibility that it might break back down to 410, but I think that would be bought and then rally through. So the measured move based on the time spent in consolidation would give us a crazy $5.70 target. The way the flag works is it generally retraces, and I think it trades up to 70% of the move here. So you can appreciate that, 330. So this is a dollar move. So based on just a very quick, eyeball on this, 70% of that would be another 70-cent move out of this range. So that would give us a $5 price target. So from a classical pattern perspective, this would potentially give us a price target of $5. Then we expect to see some prices, we see price action consolidate and then maybe rally into this 570. That'd be pretty crazy. But we have some nice relative strength here. We can appreciate that Kinross is actually performing better than its sector and the index that's present. So it's very good setup here. Your risk though is this 200-day simple moving average. So I'm certainly advocating a long position, but if we lose this, you might want to stop out and then add here on the 200-day moving average. But really just a mature thing to do is to recognize that there is some downside here. We're kind of, buying in the resistance or buying at highs here, and acknowledge that and take a smaller position. So, if our downside is from here to here, maybe just take a 25% position. If we rally through here and then we back test this prior level of resistance as support, and we rally through, you can add to your position and then trade into this. Otherwise, if we break down, you're not going to lose any sleep at night, and you can actually increase the size of your position off the 200-day moving average, and then still look to achieve these objectives.